So it's 12:30. Welcome everyone. Day 3 of this week's Investing for Income event. Today, BBGI, Duncan Bell from BBGI. BBGI is a £1 billion market cap, London listed, globally diversified infrastructure fund. We still often refer to infrastructure as an alternative asset class. A much larger percentage of my career in the city has involved listed infrastructure than it hasn't, and so I'm not really sure why we still refer to it as alternative, as it's pretty well established on the London market as an asset class for all investors. BBGI was really the first to be internationally diversified from the get-go. It is possible to get some diversification elsewhere, but this is really at the heart of what the team set the business up to do. And you know, I refer to it as a business because it's a little bit different from other infrastructure funds in that it's not a fund, it's an internally managed company. And Duncan's going to come on to talk about why that matters from a cost perspective to you, the investor, and also how it aligns management with the interests of shareholders. And because this is an income event, I think it's pretty interesting to note that BBGI is able to already tell us how it sees the dividend stream for 2023 going with a 6% increase year on year, but also some visibility over 2024. Now we have to be careful and make sure people understand this is a target, not a forecast, but a similar increase again for 2024. And clearly for an income investor, that kind of predictability is really appealing in an environment where inflation is worrying people about sustainability of dividends. And so with that, I'm going to hand over to Duncan. Duncan's going to set the scene and go through some of the investments, and then at the end there's a chance to ask questions. There's a box you can type questions in. I'll be reading those questions whilst Duncan's talking, and then after about 25 minutes, half an hour, we'll have a Q&A session. So with that, Duncan, over to you.
Very much, Alan. I guess what I'd like to talk about today is just predictable income in an uncertain time and focus on how we believe BBGI can help deliver that. I'll just describe our investment proposition briefly. So our purpose is to deliver social infrastructure for healthier, safer, more connected societies while creating sustainable value for shareholders. Our business model is based on 4 strategic pillars. So low risk, globally diversified, strong ESG approach, and internally managed. The strategic pillar of low risk is based on our availability style investment strategy. All our revenues come from secure public sector counterparties. This results in highly predictable and stable cash flows with high quality inflation linkage. The second pillar is our global diversification. So we're focused on AA and AAA rated countries, and we focus on countries with a well-established operating environment, and we focus on delivering positive outcomes for the society and the local communities we serve in those markets. The third approach is strong ESG. So ESG is integrated into our business model. Our portfolio delivers strong social impacts, and we're categorized as an Article 8 socially beneficial investment under the new EU Sustainable Finance Disclosure Regulations. And we've also done a lot of climate resilience testing, and we're very confident that our portfolio will perform well in future scenarios. And then the final leg to the table is our internally managed structure. This is our fourth strategic pillar. We're the only infrastructure company with an in-house management team, and our interests are aligned with those of the investors. We're focused on delivering shareholder value, and we're incentivized by NAV growth per share, not just growing the portfolio. We recently released our results, so I'd just like to take a moment and highlight what happened in 2022. We were able to grow the NAV by 6.6%. We have targeted dividends for, we met our dividend target for 2022, and then we're forecasting a 7.93 dividend for 2023. A 6% increase for 2024, and we've also provided guidance for 2025. Again, I'll reiterate that these are targets, not forecasts, but because of the high quality nature of our portfolio and the predictable cash flows, we're confident in our dividend forecast. And part of that reason we're able to increase the dividend each year in the future is because of the strong inflation linkage we get in the portfolio, and I'll touch on that a little later. We have strong dividend cover. Our dividend cover last year was 1.47 times. The total annualized NAV return was 9.1%, and our ongoing charge is the lowest in the sector at 87 basis points. This just highlights this slide talks about our operating model. And there's really three aspects to our operating model. We focus on value-driven asset management, prudent financial management, and a selective acquisition strategy. Over the reporting period, our 56 availability style infrastructure investments performed very well. We received high quality cash flows from our portfolio, and this allowed us to increase the NAV 76 million. The cash receipts were ahead of expectations, and there were no distributions or lockups across the portfolio. And we continue to maintain a very high level, 99.9% availability throughout the portfolio, and we are an Article 8 firm. The prudent financial management is a second principle for us. We had very modest borrowings. Our debt position was 26 million, and that was our net debt position, and we had borrowings of 57 million at year end. Since IPO, we've been able to progressively grow the dividend by 3.1%. We have a 230 million credit facility with a further 70 million accordion tranche, and that's in place until 2026. And so that gives us the firepower to make acquisitions and grow the portfolio, but we've been very disciplined in using that. We also have a hedging program in place. Because we have an international portfolio, we have a hedging program in place that means that if all the currencies were to move against the sterling, a 10% movement would only have a 3% impact on the NAV. And then the third principle that we've been following since IPO is a very selective acquisition strategy. We focus on availability style assets with strong inflation linkage and strong yield and a long residual life. And this has resulted in, we look at a lot of opportunities, but last year we moved forward with two, and we grew the portfolio, making two acquisitions for 64 million. That further diversifies the portfolio and allows us to follow this very strategic selective acquisition strategy. This slide just shows our predictable growth and growing returns since the period when we went public in 2011. The top chart shows the yearly increase in the dividends over the last 10 years has averaged 3.1%. At IPO, we promised a progressive dividend, and we believe we've delivered on our target. We have high quality contracted inflation linked cash flows, and because of the predictable nature, you can see on the bottom slide there, we know what our cash flows are going to be well out into the future. that has allowed us to increase the dividend. So we've increased the dividend by 6% for next year, 6% the following year, and then 2% thereafter. We often get the question, why 2%? Because we don't know what inflation is going to be over the next couple of years. And obviously, if inflation stays high, we would hope that we could deliver more on that. But in terms of transparency, we're confident for the next 2 years that with the current inflation levels, we'll be able to deliver the 6% per annum. If we move on to the next slide, this talks about our just sort of the portfolio, and the two key themes. Well, there's four key strengths to our portfolio. At the top, you'll see two boring but important facts. One is that we do 100% availability style, so that means we invest in assets where important social infrastructure assets where if they're available, we get paid. So we're not taking demand risk, we're not taking user risk about how frequently the assets are used. If they're available for use, we get paid. And so, and then the second aspect of that slide is the investment status. 99.5% of our assets are through construction in operation. We have one small asset in Canada, a road that will be completed later this year, and that's our only asset currently in construction. We're globally diversified. We have exposure to a variety of markets. Our biggest exposure is in Canada at 35%, followed by the UK at 32%. We're also in Australia, 10% of our portfolio, the US, and continental Europe. So we're focused on countries that have strong underlying credit ratings of AA and AAA, and strong operating environments. And then in terms of the sector split, again, we have diversification there. We have just over half of our portfolio is in roads. When I say roads, I mean availability style roads. These are roads where we get paid if the road is available for use, so we're not taking demand risk or traffic volume risk. We also have healthcare, medical clinics and hospitals, blue light and modern correction facilities, so fire stations, police stations, and detention facilities. We have education, affordable housing, clean energy, and some municipal buildings. If we move ahead, this is an important theme right now. Inflation is very topical, and I wanted to provide some further disclosure on how we're benefiting from inflation. On the left-hand graph shows the increase in our NAV and in a pence per share if inflation is 2% higher for 1, 3, and 5 years. So you can see that if we outperform the inflation assumptions we have published at our year-end results, we benefit from that. We have very high quality inflation linkage in our portfolio. It's a 0.5% linkage, meaning roughly half of our investments move in tandem with inflation. They all have some degree, but over on a portfolio basis, that's how it plays out. And the high quality nature is because of the contracted aspect. We have long-term contracts with the public sector, and these have automatic ratchet mechanisms. So when RPI or CPI, depending on the region that we're in, when those statistics get published, we mark up the invoice, send it to the client, and it gets paid. It's not tied to usage. It's not tied to elasticity of demand. And so this is very different than a lot of other inflation that people talk about, which could be subject to regulator approval, or it could be subject to elasticity to demand. So we think that one of the key aspects of our portfolio in an inflationary environment is the high quality nature of the inflation linkage. I wanted to take a moment and just highlight a couple of projects. We've got two that I will talk about today. One is the A7. It's a motorway in Germany. So this is typical of a lot of our road projects. Both this project and the next one I'll show you, both are stable operational assets and have long-term predictable cash flows. There's no refinancing risk. The long-term debt is fixed and in place. And both projects have strong ESG approaches and benefit the local community. So this project that I'm showing here, the A7 motorway, it's 65 kilometers long, but 130 vehicles per day use this motorway. Our client in this case is the AAA rated Republic of Germany. The remaining concession length is 22 years, and there's attractive inflation linkage, which is a very important feature in the macroeconomic environment. On the ESG side, we thought we'd highlight this. You can see there's an overpass there. This is an example of an animal crossing to allow migration of animals. So we across our projects, there's a lot of focus on ESG and how our assets help serve society and consider the environment they're in. The next slide I'll talk to. Oops, sorry, just having some tech. There we go. This is Women's College Hospital. So this is an iconic women's hospital in downtown Toronto. Healthcare is about 20% of our portfolio, so it's an important aspect of our business. This is a great asset. It shows what happened during COVID. We continued to get paid by all our clients during COVID. In this case, the hospital became a COVID testing center, so there was no interruption in any cash flows. The lobby you can see in that image became a walk-in clinic and testing area. We're paid by the Ontario government. The concession runs until 2043. We own 100% of this project, and it's been a great project for us. It's been operational since 2013, and recently met with the client. They're very happy with the performance of the asset, and it's typical of the types of assets we have in our portfolio. I wanted to take a moment and just talk about our role as a responsible investor in social infrastructure. ESG is fully integrated into our business model. The management board's compensation, so myself and our CFO and the other co-CEO, Frank Schramm, we all have compensation tied to ESG outcomes. All our staff are trained in ESG. We promote socially beneficial investments. So under the SFDR, we're an Article 8 product. We follow a number of frameworks. You can see there's a number listed here, but we follow the UN Global Compact. We have a UN PRI rating of 4 stars and 5 stars. We've been rated by Sustainalytics as having negligible ESG risk, and ISS Corporate has rated us top decile. So we take ESG seriously. All of our assets have been through robust climate screening and climate resilience testing. The purpose of this was to determine whether any assets would become stranded assets in the future as we feel the effects of climate change. So all our assets were screened, and any new asset as well is screened for climate resilience. So we've looked at 8 different perils under 3 different time horizons and under 3 different climate warming scenarios. So we're confident in saying that our assets are well placed for the future as we all deal with the effects of climate change and global warming. We have a robust net zero plan. We think this is an opportunity to do well for ourselves, but also do well by the planet. We think that our public sector clients will be focused on trying to upgrade the buildings to meet their targets. So we believe that there may be opportunities for improvements in the building that can be funded by the clients. So there's an opportunity for some addressing the effects of net zero and how we can move there together with our clients. And we have a very rigorous ESG monitoring program, and that's part of our extensive asset management program. Internal management, Alan mentioned that at the beginning, just to highlight what that means. We are the only equity infrastructure investment company which is internally managed. What that means is there's no external manager providing advice to the fund. We, myself, the rest of the team, we're all employees of the company. We're all focused on what matters to investors, which is NAV per share growth. So there's no NAV-based management fees. There's no acquisition fees. We have the lowest ongoing charge in the sector, 87 basis points. But we think it's also the right governance model because it means we're motivated to do deals when they make sense for shareholders. We're not motivated just to grow the portfolio and growth for growth's sake. So I think that's been a key part of why we've been disciplined in our strategic approach and why we've continued to add to the portfolio in a very disciplined manner. And then just to conclude, to recap, in a challenging macro environment, we think BBGI is a good solution for predictable income in uncertain times. So we have a low risk, resilient portfolio. It's all from availability style, important infrastructure assets. We're globally diversified. We're in AA and AAA rated countries. We have a sustainable investment portfolio that benefits from its SFDR Article 8 classification. The performance, again, in a recent reporting period has been very strong. We've delivered consistent operational performance. We have low correlation to other asset classes. And the internal management structure means we've been disciplined in our approach, but it means we also are well positioned to grow should opportunities present themselves. And finally, we believe that the markets we're in remain attractive. There's growth opportunities, but as always, we'll be disciplined and selective in our approach towards growth. And we're confident we can continue to grow the portfolio and manage the portfolio in a disciplined manner to deliver stable, predictable income in these uncertain times. So with that, I'll stop and turn it back over to you, Alan, to moderate any questions that may have come in.
Thanks, Duncan. So it's always a good idea to start with politics, isn't it? And but it is a recurring question, I think, with not only with infrastructure but also with renewables. There's a kind of perception, isn't there, that there's a political element to whether infrastructure can thrive, and maybe reality is a bit different to perception. And so do you want to talk a little bit about that? And also, do you want to talk about the jurisdictions you operate in and how you see them and how perhaps you see the direction of travel for infrastructure in your sort of key jurisdictions that you're already working in, and also where you see maybe there are kind of future opportunities in other parts of the world that can see how this model works and perhaps are becoming more positive towards it.
Yeah, I mean, thanks for that question. I think we tend to be somewhat agnostic as to who might be in power at any point in time in the different jurisdictions we're in, because as a sweeping statement, most governments are supportive of infrastructure. There's a McKinsey study that shows the impact of infrastructure on GDP growth, and dollars invested in infrastructure tend to have a multiplier effect. So irrespective of which government, which group forms government on any given day, new schools, new hospitals, new roads that benefit trade and growth are generally seen as positive. So there's a consistent view that infrastructure is beneficial for the economic growth. The other thing that is playing out on a global basis is following COVID, public sector's balance sheets are stressed. There's a lot of government borrowing, and their capacity to deliver this infrastructure without private sector involvement is diminished. So we see, PFI is a bit of a dirty word in the UK, but we continue to see public-private partnerships or availability style deals being done under different names. So, in Wales, they're developing roads, they're using a mutual investment model, but it looks a lot like PFI of old. It's been rebranded and rebadged, but it's the private sector helping deliver critical infrastructure. And so I think that's a recurring theme in the jurisdictions we're in. We also benefit from the fact that we're not dependent on any one single market. So there have been times when some markets are very active and there's a lot of opportunities, but equally there's times when markets slow down. And by being in Australia, in North America, in Canada, and the US, and in continental Europe as well as the UK, we feel we've got enough opportunities. Our opportunity set is broad enough that we can still grow our portfolio in a disciplined manner without having to compromise our values or go into markets we don't understand. So we've been very focused on staying in markets that we're comfortable with, that match the criteria that we previously described, that have well-established operating environments and strong offtakes, strong counterparties.
Yeah, great. Thanks, Duncan. And do you want to talk a little bit about how the valuation is calculated? It's obviously been quite a hot topic in this rising interest rates environment. How NAVs for infrastructure and other assets of a similar nature are calculated. Just for it'd be quite a good sort of fundamental thing for some of our viewers to understand, I think.
Yeah. So what we do is we come up with an internal view of our NAV, our portfolio net asset value, and we look at each of the 56 investments we have. We in times when there's a lot of transactions, we look at market comparables and we see what are these assets trading for. We develop that view. It's then we then have an independent auditor or an independent valuer who reviews that and opines on that. And in this case, it's KPMG is our independent valuer, and then our auditor is PwC, and as part of the audit process, they also opine on it. So both firms tend to have pretty good market knowledge about transactions, because they value portfolios for listed and unlisted funds, and they do a lot of M&A work in the social infrastructure space. So they tend to see a lot of the deal flow as well. So they're well informed. We use a discounted cash flow analysis. We increased our discount rate across the portfolio to reflect what we thought were higher discount rates, and so the market has adjusted. The discount rates were quite low, but they've moved up. We're using a 6.9 discount rate across the portfolio. And the way we look at that, we used to talk about a pickup over the risk-free rate, and we would look at the risk-free rates of each of the countries we're in. And we continue to do that. And but part of what we're also looking at is how the portfolio performs in different environments. And in rising interest rate environments, we suffer because discount rates have gone up, and that perhaps lowers the valuation. But at the same time, usually when you have higher discount rates, it's due to inflation, because of strong inflation that translates through. And then a unique aspect of our portfolios of social infrastructure assets is we have a tremendous amount of cash on deposit, because these are all these assets are financed on a project finance basis. So it's non-recourse lending. So each project has to wash its face. So across our portfolio, our market cap is just over £1 billion sterling, but we would have 400 million in various accounts as a debt service reserve accounts, major maintenance reserve accounts. So while rising interest rates hurt us on the valuation side on the discount rate, we benefit from the higher amounts we earn on deposit. So those have been offsetting to some degree. So in terms of the valuation, we've seen our NAV rise a little bit last year, despite higher discount rates, because of the benefit of inflation flowing through, and because of the deposits and the inflation linkage. Does that answer the question?
Yeah, and I think you touched on a really important point that I think there's a kind of perception, isn't there, that the discount rate is this mythical number that is almost plucked out of the air magically. But actually, it's in many respects, it's an output, isn't it? The valuer has a whole database of transactions, and the starting point is how much are people willing to pay for similar things, and the discount rate is a function. It's an output of putting that value in, isn't it?
Yeah, I mean, we can't just manufacture these numbers. They're based on market observed transactions.
Yeah.
And while there were fewer transactions late last year because of sort of the dislocation effect of the mini budget, and we saw some processes that were underway that got stalled or delayed or canceled. But we're seeing a return to a more healthy market now. And the demand for these assets is still strong. There's been a slight adjustment in pricing, but I think what the last couple of years have taught us is that the highly predictable nature of the cash flow is valued. We got paid during COVID when a lot of other asset classes suffered because of the contractual nature and the government counterparties. And now as we move from a benign inflationary environment to quite a high inflationary environment, people are also seeing the benefits of the inflation linkage, where it's contractual. It's not theoretical. It's not subject to approval. It's not, for instance, in real estate, you might have the ability to increase rents, but if the tenant can't pay, or if you've got rising CPI and tenants are defaulting, you may not get that exact flow through. Across our portfolio, a statistics CPI is published or RPI is published. We mark up the invoice by that amount, send it to the public sector client, and they pay us without question. So we haven't had pushback on the portfolio. So I think the robustness of the cash flows, the resiliency of the cash flows have meant that there's continued demand for these assets. And so while there has been a valuation adjustment, which we've reflected in our year-end valuation, we were still able to, the offsetting benefits of inflation and higher deposits more than compensated for the slightly higher discount rates across the portfolio.
You've just neatly answered several questions that I hadn't asked you that have come in whilst you've been talking, so that's really helpful. Just on a slightly different tack, I mentioned the listed infrastructure sector has existed for almost 20, I think it's 20 years next year in London, and so it's a pretty well established sector with a pretty well established pattern of raising capital for new projects, and typically quite low construction risk. You alluded to that, but if we suppose that capital raising is on hold for some time, it's been on hold for a little while now, hasn't it? How does that affect how you manage your business? Do you see yourself taking more construction risk, or are you happy to manage your way through until fresh equity capital is available?
Well, I think it goes back to sort of our disciplined approach, and we've always taken a prudent approach to financial management. So we have a 230 million pound credit facility with a further accordion tranche. And we've never had massive drawings on that. We've always been disciplined. When interest rates were very low, there was a temptation to have drawings on your credit facility because you could borrow at less than the equity returns, and you could create some attractive back leverage. We never really availed ourselves of that. We've always been disciplined that we use the credit facility to bridge to a point where we had enough aggregated demand that we could do a capital raise. So we've typically done tap issues, paid down our credit facility. And so our net borrowings are modest, 30 million pounds roughly. At year end, we had 57 million drawn on our credit facility, and that goes out to 2026. So we don't have to come back to the market anytime soon. We have traded at historically we've traded at a premium since IPO, say for a brief period for about 2 weeks during COVID. And then more recently, we've traded close to NAV or slight premium or slight discount in the last quarter or so. So while the market is closed for many, it's theoretically open for us, but we've always been disciplined. We don't have any pressing need to come back to the market. What we've said is if there's attractive deals, we will gladly do them, but we're waiting for the market to see where things are settling. And because of the prudent approach we've taken in the past, we're not sitting there with a large drawing on our revolving credit facility, worried about having to come to the market the minute it opens. So we're just doing our normal business, continuing to manage the assets, continuing to try to deliver value for shareholders, but always sensitive to the fact that we have a lot of dry powder, but we're going to be careful in terms of how we use it. We're not going to do deals just for deal's sake. We're going to make sure that they add value to shareholders.
And you mentioned, your assets are availability based. Do you want to just walk us through the process of making sure assets remain available? And both in the sense of the routine management, and obviously we understand some of that's outsourced to project managers on the ground, but just give us a sense of that kind of process, and then I suppose the what could go wrong, where availability unexpectedly disappears. I don't know. I'm going to make up a silly example of a sinkhole on a road or something, but you don't have to use that example. Where something goes wrong, how are shareholders protected, and what's the process of remediation?
So I'll use a road as an example. We joke that our roads, we're worried about white, green, and gray. White is you plow the snow in the winter, green is you cut the grass in the summer, and gray is you fix potholes and resurface the road as required. So as long as the road is available for use, then we get paid. So and we're not dependent on how many cars or trucks go across that road. So during COVID, there was a lot less traffic on our roads, but we still got paid, and we benefited there. And our schools, the same thing. Our schools, a lot of schools had very few students attending. A lot of it was just the schools were open for essential workers, children, but otherwise people weren't going to school, but we were still getting paid. And so that's kind of the availability. There are times when you you might shut the road down to do maintenance, and that you might have planned maintenance. You might do that at night, and you would suffer an unavailability deduction, but that's planned as part of the life cycle spend over the life of the asset. So we're not assuming that over the 25-year nature of a road concession, we never have to do maintenance, but that's factored in, and those no, there might be a situation where there's an unplanned event. So as an example, this first time it's happened in 11 years, but we had a minor rock fall on one of our roads in Norway. And so a lane became, or a couple lanes became unavailable. In that case, we have business interruption insurance because it was a natural disaster. It was a rock slide, and we will get paid. We will have an insurance deductible to pay, but otherwise it's a non-event for us. So as an example, we have an urban transit facility in Vancouver, Canada, and ridership is down significantly following COVID, where people are working from home, or they're going to the office less frequently, or they've bought cars or bicycles following COVID. So ridership is down, but we're agnostic that because we get paid in availability, and as long as the subways are running, we're not worried about ridership or ridership levels. So that's how the availability style works, and hopefully I've addressed your points there.
Yeah, and in terms of well, this goes to diversification as well, I suppose. But you're typically you're the control investor, aren't you? But do you co-invest, or these decisions like that are yours to make, aren't they?
We typically, we have a variety of positions. Sometimes we're the 100% owner. Sometimes we're 50% owner. It's not like we're, developing the strategy for the next iPhone. If you have co-shareholders, they're very much aligned. They want to make sure the asset's available. They want to make sure it's managed in an efficient way. So it's not like we have where we do have co-shareholders that there's massive debate on strategy. The strategy is to run the asset in the most efficient manner possible. So and usually where we do have co-shareholders, that's sometimes an opportunity to grow the portfolio in the future, because we can buy out partners if they want to sell. So there's a slide in the deck which shows our percentage but in the vast majority we have a controlling position, and that allows us to put in place our ESG approach and our policies and actively manage the assets. But it's not a case where we have co-shareholders and we have massively divergent strategies.
Yeah. And is that I think there might be a slide or a couple of slides. Just one of the questions is around diversification and what's your kind of concentration. Effectively, what are your largest investments and the countries that you're exposed to?
Yeah,
so
so
talk a little bit about that.
In terms of the countries we're exposed to, I'll just flip back. You can see our biggest exposure is Canada, followed by the UK. We're in continental Europe. In Europe, we're in Norway, Netherlands, and Germany. So all AAA rated countries. We're in the US and Australia. And you can see the sector split. And then I'll just, I'm not making anyone seasick here with the, you can see sort of our top 5 investments are outlined there. It's a well-diversified portfolio. So our largest single investment would be no more than 10 or 11%. So, and we've got diversified counterparties in terms of facilities managers and O&M contracts. We've got a long life. Our weighted average portfolio life is 20.2 years. So we've got lots of length left on the concessions. And then, this gives you some ideas of the types of projects we're in.
All this information
It's
is on the BBGI website as well, isn't it? So
yeah, and
yeah. And do you manage currency for the capital or the income? Do you have any hedging strategies?
yes, yeah. So we hedge the dividend for the next 4 years, 100% of the expected dividend. We have balance sheet hedging, which is meant to limit the. I've got a slide on hedging here. Just bear with me. We hedge the dividend, so a 10% movement in all the currencies against the sterling would have a 2%. Yeah, here it is. So that just discusses the hedging approach.
Yeah. Okay. That's really interesting, Duncan. Thanks. Thanks for giving us the time.
Yeah, and apologies for there's a lot of information there. I was sort of trying to be selective in what I presented, but if I know there were a couple questions in the chat about valuation, and I'm more than happy to discuss that if anyone wants to drop me an email. And there's a lot of detail in our annual report and in our results presentation. I just didn't want to get too in the weeds on valuation for a large audience, but if someone has specific questions about that,
I think the Kepler audience is always happy to discuss a discount rate and a discounted cash flow model. We're not. I think they're all quite a sophisticated bunch, but our time is up. So as ever, as Duncan mentioned, the BBGI website has a lot of information on it, and of course so does Kepler's website. You know where to find us. If you have questions for Duncan, you can email us or you can email him directly. Really appreciate everyone turning up. I know some of you, this is day 3 for you of 5, so look forward to seeing you later in the week. And Duncan,
well, thanks very much, Alan,
again,
and thanks for the folks who joined in and for the interest in BBGI.